Thanks for clicking! The London and St. Thomas Association of Realtors has released its data for the final month of 2023, showing a real estate market that is very different than that which we've seen in previous Decembers.
It's not.
No.
It's not.
While many over the past few weeks have been predicting a big turnaround in the housing market with rate cuts just around the corner, the London market is showing much more supply available than we've seen going into previous new years, with the big question being whether or not demand comes back. With 5-year fixed mortgage rates dropping on the heels of the major drop that we've seen in bond yields, buying power is definitely better than it was a few months ago. But, as we'll see today, it's not quite where it was a year ago. And, as with anything, context matters. So what I want to do today is go over London's real estate data for the month of December, take a look at where we stand this year compared to where we were last year, and then discuss what to look for next heading into 2024. We do have a big couple of weeks ahead of us, with Stats Canada set to release Canada's CPI data next week, and the Bank of Canada set to make its policy announcement the week after. We'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, if you'll remember, that's the price of a home that represents the most popular set of features. The benchmark price was down in December. The benchmark in November was sitting at $577,400 and dropped about $6,000 to $571,200 in December. So that's about a $6,000 decrease in the price of a home that has the most popular set of features in December, only up about 0.5% since 1 year ago.
A golden opportunity like this?
With that said, the average price actually increased for the first time since August, with the average in November sitting at $594,200, bumping up over $20,000 to $614,887. So that's about a $20,000 increase in the average price of a home in London in December, bringing it back to where it was in February of 2023 when it was also sitting at $614,000. And the median price acted in very much the same manner. The median price, if you remember, that's where half as many homes are sold for over that price and half as many sell under that price. The median price in November was $560,000, and that jumped up over $25,000 to $586,500 in December. So again, that's an over $25,000 increase in the median price in December, and again, bringing the price back to where it was in February of 2023. However, while we do have increases in the average in the median price of a home in London, if we look at the sales to list price ratio, we can see that homes are still selling for under asking price, even more so than they were the month prior. The SLPR measures by how much over or under asking a home sells, so if a home is listed for $100,000 and sells for $95,000, the SLPR is 95. The SLPR in November was 97.2, and that dropped, though marginally, down to 97 in December. So, on average, homes are selling for 3% less than their asking price.
I have your best interests at heart.
And we also saw some improvement in the months of inventory measurement as well, the MOI. The MOI that measures if no more homes came to the market, how long would it take for London to completely run out of homes for sale. The MOI in November was 4.4, and that dropped down to 3.8 in December. So, in December, we did see a decrease in the amount of inventory relative to that of demand. So, we have the benchmark price down about $6,000, we have the average price up about $20,000, we have the median price up over $25,000, homes are still selling for under asking price, even more so, and we have a bit less inventory on the market relative to that of demand. With that said, I think the real story coming out of December's data is the number of active listings available, sitting at 924 at the end of December. And while that doesn't mean anything in and of itself, that's a 37% increase from this point in time last year, and a 900% increase from 2021, nearly 300% increase from 2020, and 80% higher than we had in 2018. We hear so often from the usual suspects from the media about pent-up demand, but these numbers tell me, in London at least, that we have a lot of pent-up supply. Supply that was listed over the past few months, which has yet to sell. And, all things being equal, if we have more supply than we do demand, prices should continue to fall. So the question becomes, where is demand sitting? Bond yields have been coming down substantially over the past couple of months with mortgage rates falling, but is affordability that much different than it was a year ago? A year ago when we saw the spring market take off once again. 1 year ago, a decent 5-year fixed rate was sitting at 4.79, back when the big banks were predicting a hold or cuts by the end of 2023. Yeah, remember that when the usual suspects are pushing current market predictions as a means of instilling FOMO without referencing market track record.
My memory isn't what it should be.
Regardless, fast forward to now and a decent 5-year fixed rate is sitting at 5.14. So, 1 year ago, when rates were at 4.79 and the benchmark was sitting at 567K, buyers had to qualify at 6.79 and needed to earn about $135,000 with zero debt in order to buy that benchmark priced home. Fast forward, using today's benchmark of $571,000, buyers now have to qualify at 7.14 and now have to earn $140,000 to get that same benchmark priced home. So, buying power is a bit less than it was a year ago when the market took off, but nothing really significant. With that said, the economy definitely isn't where it was a year ago either. 1 year ago, we got headlines that Canada had added 104,000 jobs in December and the unemployment rate was at 5%, compared with 0 jobs added in December and an unemployment rate sitting at 5.8. Further, in addition to the unemployment rate, we're also seeing weakening in the credit markets, with Equifax reporting late in December that we're seeing a major increase in delinquencies, a major increase in late payments.
In Ontario and BC, we're seeing quite a significant increase in missed payments and delinquencies. So in British Columbia, about 122% increase, quite significant. Here in Ontario, just over 40%.
So yeah, buying power might be close to where it was a year ago. Rates may be close to where they were a year ago, especially if they continue to come down. But context matters. We do have a lot of pent-up listings heading into that spring market. We do have a weakened economy, and we have a credit market that is showing signs of stress. So even if demand does come back to the real estate market over the next few months, even if we do see that spring pop up in demand, with rates being in and around 5% give or take over the next few months, it's not clear that that demand is coming back to the same market that we had last year. The economy is different, the credit market is different, rates are different. As I said in December, I think this is a very uncertain real estate market. No one knows what's going to happen. No one knows if demand is going to come back, what listings are going to look like, or what the economy is going to look like. With that said, we will continue to track all three on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.